Well, it was only a couple of months ago that I was in the offices of Omba in London. Mark Perchtold, who is the founding director of the company, is with us now. You weren't around at the time. We met with Stephen Brearley. But what was interesting, Mark, is that your office is just over the road from where I was based in London at the WeWork, which then was, but I guess
Yes,
WeWork is
yes.
now closed down. It's a good central location, but why did you guys, you are South Africans, why did you base yourself there?
Well, we actually started a little closer to my home in Wandsworth, which is in southwest London, just because the cost of having a central London office were exorbitant when we were setting up. And many of our clients were in South Africa in the early days. We've now got a much more UK-centric client base than when we started. And most South Africans that come to London didn't really know much difference as to whether it was Wandsworth or central London. It was just a London postcode. So it was fine to have an office there. But as we did an offsite for the team in 2019 pre-COVID, and everyone unanimously except myself, because it was close to my house, wanted to move to central London. So we agreed to move, and then COVID hit, and then we worked from home for a long period of time. And we decided to go to the South Bank because most people were commuting into Waterloo or London Bridge, and so it's a very central location, and you could pretty much get anywhere in central London within 20 minutes. So great location for us. We can just see the River Thames from our terrace, so we're slowly getting into the heart of the action.
Why London, though? What was the appeal of that city for you guys putting together the business that you have?
Oh, I mean, we were already based in London. In October I will have been here 18 years, and Dave Pearson, the co-founder with me, has been here in and out of London for 20 years. We were at university together at Wits, but as you know, there's a sad brain drain from South Africa, and many people with skills leave, and many come to London. And most come for a 2 or 3 year stint when they're young, which was my intention actually. And I got caught up in a really good job, and the rest is history. But London is a great location from a investment perspective. You really are in the center of the world in terms of financial services. You've got, obviously, Asia's far away and the States is far away, but we're right in the middle. And a lot of financial services firms have either subsidiaries or branches or offices in London, even if they're from abroad, and many are headquartered here. So you really feel like you get proximity to the action of what's going on in product development, in financial services, in trends in the industry. It's also a very well regulated jurisdiction. So investors get comfort that they're working with a jurisdiction that's got good rule of law and governance if something went wrong. And you're well regulated, and sometimes too well regulated with the regulatory burdens of today. But we think that serves investors well.
So 18 years that you've spent in the UK, and yet you very South African by your accent. Are you doing a lot of business still with South Africans?
Yes, very much so. I mean, the bank I used to work for, when I left there, I was head of the South Africa team that focused on building out the South Africa business for that bank. And I was traveling back at least 8 times per annum for 12 years or so. And so I have a lot of good relationships and connectivity to South Africa. Dave, co-founder with me, South African. A number of our first employees are South Africans in London, and so we've got a very strong South African centricity to our business. But we're a London-based UK investment manager, and so our business has evolved, particularly during the COVID period where we couldn't travel back to South Africa, and so we've got a lot more UK business now. But we're not going to forget about South Africa. We love going back, whether it's for business or pleasure, and we'll continue to do business there in the future. But yes, we've got the South African flavor to us, and we think it actually gives a lot of South African investors comfort in going to our website, reading our biographies, and looking at who we are and saying, oh well, I understand Wits University, I understand that degree, and we're not Oxbridge, so we didn't go to the best British universities, but when a South African comes and reads our education history and backgrounds, they get a good understanding of who we are. So I think the South African market's a natural go-to place for
You
us.
do approach investing quite uniquely, very differently from most fund management houses by focusing on exchange traded funds. Now, where did this idea come from?
So it goes back quite a while, actually. I mean, in my prior role, we were building multi-asset portfolios for clients with fixed income and equities, and the building blocks of those portfolios were typically either single securities, funds, either from the house itself or third-party funds, sometimes structured products, etc. And very little use of ETFs was taking place at the time. And the reason for that was that a lot of wealth management firms were earning a margin on the products and the construction of those portfolios because of the way in which they populated those portfolios. And I found myself sitting in meetings with fiduciaries, trustees and lawyers and tax advisors of clients asking, why are you using these products for this allocation when you could just buy the S&P 500 ETF and it costs 7 basis points and at least you track it and you don't underperform? And so it really took me on a journey going back to probably 2013, 14, where I deep dived into ETFs and thought they were a fantastic building block to build multi-asset portfolios. And the evolution of ETFs, even since then and even at that point, had been that you could actually express active views as an active manager with your tool set being ETFs. So we're not passive managers, we're active managers. We express active views, but our tool set is ETF. So you can express a view, on a country, on a sector, on a theme, or on a factor where you want to factor or smart beta investing has evolved substantially as well. So you can actually have quite a nuanced view, and in fixed income you can express a view on credit quality or duration or currency, all through the use of ETFs. And that wasn't there 10 years ago, but it's certainly there today. And we've been specializing in that since we started. So the big driver was also trying to keep costs down to the client. So ETFs are a low cost implementation tool, and then we don't charge high fees. Our fees are 0.3%. And so the all-in cost to a client for an actively managed process that's inherently diversified, because you're using ETFs which are tracking major indices, and those indices are made up of stocks which are seasoned enough to enter that index. You inherently have high quality companies in those indices, and not always in today's world with a lot of the thematic ETFs that exist, but in general within the main. And so, it's a great building block for portfolios. And so we thought we'd be differentiated. We wouldn't tie ourselves to one ETF product provider. You do get solutions from some of the big houses, which are only the ETF product provider's own multi-asset solution. We're product provider agnostic. We're not owned by any big house. We don't have any deals with any big house. And so 8,000 plus ETFs in the world, and we can use any of them really, with consideration of tax.
That's quite extraordinary. You're an active manager that charges 30 basis points, 0.3%. That's it. Is that all the fees?
Yes, that's it. So for our segregated accounts, so when we got going, a lot of people will leave a big organization to set up a firm or fund, and they will try to raise money, and they'll go around to family and friends and some connections, and they'll put together 2, 3, 4, 5, $10 million. But the costs of running a high quality fund in a credible jurisdiction, and our funds are all in Ireland and the Irish UCITS funds, so they under the EU regulation called UCITS, and that affords investors a lot of comfort, but it's very expensive. And so if you don't get to scale pretty quickly, you're basically going to go out of business. And we didn't want to set up a business that went that route. So what we did was we started by running segregated accounts for clients. And clients will sign an investment management agreement with us, and we will build a portfolio of ETFs for them, depending on their base currency and tax considerations and risk profiles, and we do a suitability and appropriateness assessment. And for that segregated account business, it's 0.3% management fee. For the funds themselves, we've also done something quite unique, is we've capped the total expense ratio. So all the costs of running a fund, so your depository or custodian fees, your administration fees, your manager fees, your legal fees, your audit fees, your product cost of the underlying ETFs themselves, and the investment manager fee adds up to quite a lot. And therefore, generally, you see in the market, a lot of smaller funds and new boutique funds have very high total expense ratios. And if they don't, often the firms go out of business. But what we've done is we've decided to drop our management fee, basically not draw as much of a management fee, but in order to cap that total expense ratio. So when you add up all the costs that I mentioned, on our moderate risk fund, for example, we've capped it at 0.8%, but the total expenses currently run up to about 65 basis points. So we can only draw 15 basis points. But we're of the view we're in this for the long game, and as our funds will continue to grow in AUM, eventually we can draw our 30 basis points. But that's quite unique. So an investor knows on day one, I will not pay more than that fee for every
And
single
your own
layer of
money is
costs.
invested in your funds as well. And what I mean by your own money, you and the other co-founders.
Absolutely. I mean, from a personal perspective, most of my other than my house, I'd say 80% of my other savings are in Omba funds. So yes, very much so. And I think it's important because you want to align your interests with your clients. So when you're having a tough year like this year in markets and portfolios are down, you say, well, so am I, and it's painful, and I understand, but these are the reasons you need to stay invested. And so does make a big difference. I think aligning interests, and obviously we're a small firm with limited number of people, and many people have equity in the business too. So our future destinies are aligned with our success, and so performance of our funds and our business is aligned with staff and everyone. So aligning interest is one of our business principles. If anyone wants to look at our website, they will see we've founded our business with core principles and values which we think will help us become successful over the
How
next
long have
20
you
or 30
been going
years.
for?
So we're 5.5 years in now. We started in Jan 17. So we're not a startup any longer. We're still a young firm. We've got about, in rands, probably 5 billion rand of assets. So we're very much up and running. But it's a long journey, and at 30 basis points fees in general, we're not about to retire. So we're not a 2 and 20 hedge fund or private equity fund where if you had 5 billion at 2 and 20, you'd be smiling. At 30 basis points, you've got to really get to scale to enjoy the fruits of your labor. And the big thing for us is really trying to deliver an investment proposition to savers that competes with the big houses of the incumbents of today. And investors get great diversification, and they work with a firm that aligns interests with the client ultimately. And that's sort of how does teach. My mom's a teacher, retired teacher. She once went to a financial advisor and was put into very expensive product at 2+% per annum in fees. There was a big slice taken off on the day one investment, and she came and showed me this portfolio they'd put together, and I was furious with her because I said, Mom, you could talk to your son. I do this for a living. And she just was none the wiser and said, I didn't want to bother you. And she was saving 200,000 Rand. She worked for the government in South Africa for the Gauteng Department of Education and didn't have a lot of money saved. And I just got frustrated. Investors shouldn't have to pay that much in fees, particularly in retail. And the family office, ultra high net worth, and institutional world will be able to negotiate very competitive fees. But a teacher or a nurse or a health worker, who wants to save 100,000 or 50,000 Rand is probably going to get overcharged somewhere along that journey of allocating their money. So we really wanted to do something different to cater to that universe in the long term. But you can't start with that part of the market. So the core of our client base has been family office and ultra high net worth. And high net worth, our minimums are for the segregated accounts have always been pretty high. So you're looking at sort of £2 million or $2 million and upwards in general. So it's not accessible to many people, but that's for the segregated accounts. For the funds business, our moderate fund is available to someone with £1,000,
And then
$1,000.
from a South African perspective, you're talking about 20,000 Rand.
Yes, exactly. And we're in the journey of getting our funds onto platforms in South Africa. So we've got 3 funds. I can't talk about the latter 2 because they're not yet regulated there. But the first one we have is under the Prescient, who people know the firm Prescient in South Africa. It's under their ICAV in Ireland, and we've got that fund approved for marketing in South Africa. And so we're in the process of getting it added to various platforms. You'll be familiar with the LISPs in South Africa. And getting access to funds requires them to be connected on a LISP. And so we're on a few already, but still getting connected to more. And then, people can talk to their financial advisor in South Africa, say, I've heard of these Omba people in London. I really like what they're doing. I would like a portion of my money to be allocated to them. And so we're going to partner with many of the financial advisor firms in South Africa to say, have you looked at what we're doing and how we differentiated versus some of the managers?
It's an interesting process that you've spoken about. I guess in theory, it's for highly sophisticated investors, but in practice, not so. Warren Buffett's been beating the low-cost drum for a long, long time and trying to say to people, if you just take a 1 percentage point additional cost, over the long term, it costs you huge amounts. It can take a quarter or a third of your final capital amount, perhaps even more. So it's not really that difficult a message, but is it getting through globally? I mean, you guys have focused costs on the one hand. We'll talk about performance on the other. I pretty much know what you're going to say about that, but we can talk about that later. But cost is one of the things that isn't really paid a lot of attention to, certainly not in South Africa, but is it from where you're sitting?
Absolutely. I mean, people are generally when there's a crisis, and certainly post GFC, there has been a lot more scrutiny on fees. The ETF boom is partly driven by the fact that if you look at various studies, academic and other publications that come out, most active managers net of fees don't beat the benchmark. So why not just own the benchmark? So if you want to allocate to US large cap equity, just buy the S&P 500. You're not going to go too far wrong because they're the 500 largest companies by market capitalization. The dogs eventually fall out, new winners enter. And so over time, you have positive selection bias. And it's a pretty straightforward way to allocate. But if you're sitting in, I don't know, South Africa or Argentina or Brazil or, Southeast Asia somewhere, and you're worried about, your own domestic currency and political and country risks, and you never know what's going to happen in 20 years or 30 years, and you want to allocate globally, you don't really know where to start. So do you go to just the S&P 500? What happens with the US? The US has issues too. Or do you go to the stock 600 in Europe? Or do you go to the Nikkei 225 in Japan? Or do you look at the CSI 300 in China? There are a lot of ways in which you could think about allocating offshore. And so what we're doing is trying to help them navigate in that journey and say, we're doing that. That's the core of what we do. We're global macro managers looking at the world all the time, and hence active in thinking about, do you want to be a little bit more in this or a little bit less in that? And some examples would be for this year, for example, when the troop buildup occurred on the border of Ukraine from the Russians. In late January, we had a number of investment discussions, and then finally an investment meeting to pull the trigger on a tilt to go overweight European energy stocks. So there's a sector ETF in Europe. You can through that ETF you'll get access to the likes of BP, Royal Dutch Shell, Total, etc. And you can go overweight that sector. And so from our broad European exposure, which let's call it the stock 600, we sold some of the stock 600 and we overweighted the energy sector. And that was an active decision, and that ended up helping us. And then after the invasion occurred, we added to it further via US oil and gas explorers, which also did very well. And in the second quarter of this year, we removed that overweight because we had done very well on the position, and we moved back to where the funding source was. And so as we think about the world, like for example, we've been underweight US tech last year because we felt US tech was overvalued. We did have US exposure, but this year the Nasdaq's down circa 30%, and US large cap technology companies have been beaten up, and valuations are starting to look more reasonable. And so now we can start thinking about allocating some of our US or European allocation to US large cap technology. Another example in countries would be when Trump was elected. You might remember he wanted to build a wall on the border of Mexico. He wanted to break down the NAFTA agreement, which ended up being reconfigured into a new agreement. And the Mexican peso sold off, the Mexican stock market sold off. And we looked at it and said, you know what, this is starting to look attractive. And so from our broad EM exposure, we took some of that exposure and we put it directly into the whole Mexican market. We didn't pick one company in Mexico. We bought a Mexican ETF. And so we got broad exposure to Mexico. And so that's the type of thing we're doing within the portfolio actively, because when you're sitting in South Africa or anywhere and thinking about the world, it's very difficult to decide.
It's so interesting because if you were to invest your money into an S&P 500 index, as you mentioned earlier, then you are going to beat 70%, maybe 80% of asset managers or active managers. But from the way that you are structuring things, from what I'm understanding, is that you got that sussed anyway. So you're going to beat 70 to 80% of active managers, but you're going to enhance that return even more by just making bets in exchange traded funds when the opportunity exists, as you've explained with the Ukrainian border troop buildup, for instance.
Yeah, I mean, the goal is there's two parts. One is obviously you want to outperform major indices. Our goal in general is to beat inflation by a certain percentage over the long term because people want to have real growth in their assets. And a lot of the major indices which people would have heard of, whether it's the MSCI World or MSCI Acqui or FTSE World indices, these indices are very US centric. And if anyone's got the time and wants to read 200 pages of the MSCI index construction rules, you'll see that they're almost designed to be US centric. And if you objectively thought about, I've come from Mars, I've just landed on this planet, and I want to allocate capital, where do I go? Would you really put 60% of your money in the US? And when we were setting up our portfolios right in the beginning, we said, I don't think that's the right answer. And so we're slightly differentiated in that we don't really care about those benchmarks. We just want to allocate globally. But what's landed up doing is that our strategic allocation inherently has less US and more Asia, because you can't ignore the fact that China, India, and the rest of Southeast Asia are growing faster. They have, from a GDP perspective, they've got greater populations. They're developing. They're urbanizing. And you've probably heard the China story because of some of the big counters in South Africa that are linked to the Chinese stocks. You'll know. And so there's a very strong argument to have a greater allocation to China, particularly since they're the second largest economy in the world. And also from a capital markets perspective, if you look at the number of IPOs that have been taking place in Asia, the proceeds being raised from IPOs in Asia, it surpasses the US and EMEA by a huge margin. And so capital market activity is increasing. The opening up of markets is increasing. Over the last decade, China's opened up its bond markets, its equity markets, its currency markets. And so it's more integrated with the rest of the world's capital markets than ever before. And so if one takes a 10 or 20-year view and you're saving money often for your retirement or for your children or your grandchildren, you cannot ignore this rise of China and Asia. And so we don't think you just buy the S&P 500. You can't go too wrong, because US firms, to be fair, if they see an opportunity to have a subsidiary in China and sell into the Chinese market, they will, and the earnings would pass through into the US holdco. And so a lot of US earnings are actually global. I think in the S&P 500, it's north of 50% of global earnings. So you're not that US centric. And in the UK, the FTSE 100, 70% of FTSE 100 earnings are not UK. So people buy the FTSE 100 thinking they're getting the UK exposure, and they're actually not getting UK exposure at all. So we think about that too in our allocations. How do we really want to express that view? If you wanted to own UK Inc., you're better off owning the FTSE 250, which is far more UK centric.
And give South Africans a inside track into what's really going on in the world, not just the names. Mark Perchtold is the founding director of Omba, and I'm Alec Hogg from BizNews.com.